today it's really exciting. I'm really, really happy to be doing this because there is no better time. Uh, there's no better time to be um, planning for your taxes than now. There's so much change going on. But there are so many changes happening right now. I mean, besides for the fact that we just had this brand new tax law change that we went ahead and that got passed back in July, that's going to have a lot of effects on the 2025 tax year, and then also 2026 and moving forward, and then we're in 2028 and 2029. A lot of the changes are going to then backtrack and or be extended, but certainly we'll have to see. So let's jump right into things. I like to start with a quick riddle, so you can put your answer in the chat. But well, not really a riddle, but more something that I ask people all the time is, what is the money that the government may or may not give back to you after you file your taxes? What is that called? Choice A is a return, and choice B is a refund. Let's testing your tax knowledge to get everybody awake. I know it's a little late on a Sunday night here, and I very much appreciate you taking out time of your evening to join me on this. But yes, very good. It is a refund, not a return. The return is the forms that you file with the IRS, with the government, and the refund is what you get back. Although sometimes getting a refund is not a good thing, and we will talk about that. So my name is Yehuda Tenenbaum. We will be talking about a bunch of things. We're going to be talking about tax changes, an overview of the 2026 tax season, which is for the tax year 2025. There are a lot of new updates to go through, and really it's going to take some work to figure out how does this apply to your situation. And really the important thing that we should do, and I apologize, the date is really today is the 7th of December, not the 8th. I do apologize for that wrong date. So preparing for this upcoming tax season, there's a lot of tax law changes, and I am here to guide you through this. I read tax law for fun, and I mean, I say for fun, but also because it interests me and it's something I'm doing on a constant basis. There's so much coming out right now. Everything that was passed back this past July, very little guidance has actually been given out. I was just today reading new not even proposed regulations. It was just request for comment on future proposed regulations. And this is something that's like upcoming soon. So I'll just start with a little introduction. Most of you know me, hopefully. If you don't know me, my name is Yehuda Tenenbaum. I'm an enrolled agent. Yes, fun fact, I do play guitar. That's me with that guitar right there. I have composed a few songs about taxes, although I'm not going to perform them here. I'm an enrolled agent. If you don't know what that is, an enrolled agent is an IRS accreditation specifically for an IRS license for tax representation. We get tested 3 really difficult tests on individual taxes, business taxes, as well as representation. So if you ever get audited, or if you get you have collections and you need somebody to step in for you, I am your man. I'm an enrolled agent, been an enrolled agent for a bunch of years now, been doing this type of work for a while, and I love helping taxpayers, figure out their situation and make the best of their situation. Been working with mostly individuals and small businesses with ongoing tax compliance support, accounting support, and I hope to be available to you as well in whatever journey you're going, whether that's your tax journey or financial journey, whatever it is. I hope to be a resource for you. Why choose an enrolled agent? Nowadays, we have a lot of issues. I'm not sure how familiar you are with this, but there's something called ghost preparers, where people will go ahead and say, hey, I'll get you a really big refund. And what they're doing is the equivalent of using commercial tax prep software to go ahead and file a tax return for you, and then use your name as if you're the one filing it. And then they end up doing the equivalent of committing tax fraud on your behalf, which, and I would never recommend, 0 stars, do not recommend, don't commit tax fraud. So being an enrolled agent, I'm here. I the FBI has my fingerprints. They know who I am, and I'm here to protect you and take care of you and make sure that not only am I giving you the most up-to-date information, but also I have a certain level of responsibility to help you. Let's jump straight in. This 2026 tax season is going to be really interesting for a couple different reasons. We discussed a little bit because, number one, there's all these brand new laws. The forms are barely even out yet. I mean, I just saw one of the new forms, which we're going to discuss, literally just came out the other day. I mean, it is the beginning of December. It is. We're just getting guidance on a lot of things. There's a lot of upheaval at the IRS. Hopefully this won't have too much of a negative effect, but right now there is no actual commissioner of the IRS. Funny story. The current acting commissioner is actually the Treasury Secretary, Scott Bessent. I'm not sure how he does any of his job, considering he's probably so busy. But regardless of that, leadership of the IRS, there's a lot of unknowns. There's a lot of uncertainty, and there's a lot of uncertainty, and I'm not sure. We're not sure how that's going to take effect. If I do apologize if the video is not working for you, there will be a recording afterwards. So I apologize. I see some people are having some trouble, but it looks like it's working for some people. So certainly, whoever needs, we will get that recording out afterwards. You can watch the replay. But there's a lot going on at the IRS. I actually had the opportunity to meet with the most recent actual commissioner of the IRS, and then a week later he was reassigned to go act as ambassador to Iceland, I believe. So that was a really interesting thing. The staffing changes and layoffs, that's been mostly we've seen that mostly for examinations, so for audits, which I'll say from a taxpayer perspective, like, hey, cool, no more audits. I mean, I think I think a fair system is a place for audits at times, and certainly we want to prevent fraud. But I think that is a little bit of a relief. Like, okay, that is not the priority of the IRS. So certainly protecting taxpayers. At the same time, there is an argument to be said for having proper compliance in place and checks and balances. But mostly, actually, the service itself, I personally have not seen a huge upheaval of like customer service. Now, getting in touch with anyone in the IRS in general is a very difficult thing. I have some tricks up my sleeves in order to sort of like skip the line, and I have different tips and tricks in order to not have to call the IRS. So that's why working with somebody like me is certainly very worthwhile, because I can help you figure out your problems without having to wait on hold for 3 hours or things like that. But very much this current administration has said that customer support is very important to them. So I'm really hoping that is going to hold true. But at the end of the day, we really don't know. Okay, so let's discuss the timeline over here, because when we make a plan, we got to know what the calendar looks like. So key deadlines. First of all, the end of this year ends, believe it or not, on December 31st. Happens every single year. December 31st is the end of the year, meaning if you want to do something for this tax year, most things, like, for example, earning income, that needs to be done this year. Now, that doesn't apply to everything. Things like contributing to IRAs, that can be done after the tax year up until the deadline of April 15th. So there is a little bit of wiggle room. Now, a couple important deadlines to keep in mind. January 31st is when you should, by then, receive your W-2s and your 1099s. Let's hope. You should. Some employers hand them out like right away, and some comes in the snail mail. A lot of people, by the way, don't realize that they can access their W-2s online. Most payroll systems have online portals. If you're not sure, ask your employer. And they'll probably say, "Oh yeah, we sent you a link when you started this job and you never signed up." That is pretty common. But you should get your W-2s by the end of January. Now, for all our individuals that have businesses, self-employment income, you have investment income on the side, your final quarterly payments are due January 15th. Now, we want to avoid you paying penalties and interest. I don't like when people have to give the government, it's like I always say, there's nothing worse than having to pay tax, but there's nothing really worse than having to pay penalties and interest on that tax. I don't want you to have to pay taxes. So, extra interest on those taxes. So make sure you get your quarterly payments in by January 15th. We're going to talk a little bit about what it means to make estimated payments. And this, I think I was going to touch on this a little bit later, but a lot of people, they go ahead and think like, oh, I want to go ahead and do all these complicated tax tricks and write things off and things like that. And little do they realize that they are going ahead and at a disadvantage because they're paying hundreds of dollars a year in interest alone because they pay their taxes late. So this is really the we're going to get into this in a second. Okay, but back to the calendar. So April 15th is the deadline. Now, the deadline, oh right, Connie, good point. The January 31st deadline for W-2s does fall out on a Saturday, and therefore it does get pushed off. Regardless, you should be getting your forms around that time, towards the end of January. Now, one other good point though, brokerage statements. So if you have investments, 1099Bs, consolidated 1099s, those usually don't come out until a little bit later. And be careful if you have a lot of investments. I've had this happen with clients of mine where they will get their 1099B for their investment trades, and then in like the end of April they'll get a corrected 1099, and then we have to file an amended return for them. So for those type of filers that I know to sort of expect an amended 1099, we just extend and push them off, and we can talk about extensions as well. Oh, here we go. Speaking about extensions, so the date, the deadline to file and to pay is April 15th. Now, the rules around if you have to make estimated payments or not is a little bit complex, but regardless, if you owe, you have to pay it by April 15th. Now, you can extend, but the extension is only for filing, not for paying. You have to pay your taxes ahead of time. So I would even say get estimates in as early as possible. That way, I'd rather you get a refund and not be stuck in having to pay extra penalties and interest. But regardless of all of that, the extension deadline is October 15th. Now, practically speaking, what ends up happening is if you don't owe, you can actually file later and there are no penalties and interest, but you have to be careful because if it comes a point after 3 years, you cannot file for a refund anymore. So you have to be really careful. Also, very often people think they're getting a refund, and we finally put all the numbers together and they're not getting a refund. So you have to be really careful. Make sure to keep all these dates in mind. Okay, OB3. So these are the major changes for 2026. We're going to go more in depth in a little bit, but just so you know, there's a lot of new terms. Now, what I want you to be careful is don't get confused, because even though it's a catchy title, no tax on tips, it sounds good. It's not really true. There's a deduction that allows you to pay less tax on tips, and the tax we're talking about is income tax, not Social Security or Medicare tax. So very important, it's very important. And this is the nuanced work I do all day long. Very important to keep in mind. It's not just a blanket, I don't have to report it. No, you have to report everything. In fact, there's a brand new form. I'll show that to you in a bit. Form 1A, and that's for people who file with the standard deduction or itemized deductions. But no tax on tips, no tax on Social Security, no tax on car loan interest, no tax on, I apologize, I said that twice. I think I may be missing one. No tax on overtime. That's what that was supposed to be. There's also these new Trump accounts, new Section 530A accounts, which hopefully can help your children actually, children that are born between 2025 and 2028, get $1,000 pilot contribution. We'll talk about that in a bit. The SALT cap. Who knows what SALT stands for? SALT stands for state and local taxes. That got raised to $40,000. That's going to affect a lot of people in high tax states, such as where I am in Maryland. A lot of people that's going to affect. child tax credit also got increased. So we're going to talk about that a little bit more in a bit, but that's going to cause a lot of people to have over withheld. New for 2026, and we're going to talk about the income limits on the no tax and Social Security. There are income limits. I believe I have it on a later slide. I think it's 150 and 300 for single and married filing jointly. There is a new form, 1099-DA for digital assets. That is going to be, if you trade digital assets, you should expect that. It's very similar to a 1099-B, just has more specific placement for the nuance and little details of digital assets. If you don't know what digital assets are, awesome. Don't worry about it. Yes, direct deposit is now required. So it used to be that you had an option. You could receive your refund either as direct deposit into your bank account, or you could get a check. Well, the government is trying to get rid of checks. Now, personally, if you ask me my opinion, big fan. Now, I'm sure this is going to cause a little bit of, trouble with people if you don't have a bank account. If you don't have a bank account, call me up. I will gladly help you figure out how to get a bank account. But regardless of all of that, as of now, so you need to give direct deposit info to receive a refund. For if you want to pay the government, they will still take your checks, so don't worry. But it's really important to make sure when you file your taxes to include that direct deposit info. Otherwise, it's going to cause delays. They said they're setting up alternatives like debit cards or something like that, which, I mean, that just sounds way more complicated than a check. But either way, make sure you include your bank info if you're giving it to your account, if you're filing your taxes on your own. Let's get into the 21st century. Use direct deposit. It's much easier when I always hear these funny stories where people will say, I've heard other people say, oh, my client told me, he didn't want to send a check to the IRS. Why? Sorry, he didn't want to use like electronic withdrawal and provide his account number and routing number to the IRS for security reasons, because then he's nervous that the IRS will have his information. Instead, he wanted to send a check. Now, for anybody that has ever seen a check, which the reality is it is getting fewer and fewer of us. I don't write that many checks. But on the bottom of every single check is the account number and routing number. So when you send somebody a check, you are inherently giving them your account number and routing number. So just get with the times, use direct deposit. And now this brings us to, I would say, the main point of our tax planning session. And I sort of touched on this earlier. A lot of people will want to do all these complicated things. And the most basic piece of advice I'm going to give you at the beginning of the session is get organized early. If you get organized early, you are in a much better position to make a difference in your taxes. If you're not organized, then everything's a mess, and then you're just busy cleaning up a mess. And I have that, and I help clients all the time. They come to me, they say, oh, I need to file 3, 4, 5 years of taxes they haven't done. And how are you supposed to strategize if you're always working in the past? So get organized. You have to make a list. What is all your income? Very often people won't realize what's included in income. Income includes everything unless the government says otherwise. Actually, I have been putting out daily video tax tips. I've been posting them on Facebook, TikTok, and Instagram. So take your choice of social media platform. But the most recent one, I discussed what's included, what needs to be reported on your tax return and what doesn't need to be reported on your tax return. A couple examples. So what needs to be reported on your tax return, very simple. Wages, income from your W-2 job, self-employment income, dividends. When you own stocks or mutual funds, you're constantly getting dividends. And I've had clients not realize this, where they'll get an email. And nowadays, because people will get their tax forms electronically, they almost don't even notice. So they won't get the physical form in the mail and they won't see it. And then they forget to send it to me. Luckily, I have ways of knowing ahead of time whether or not somebody is, might be excluding income as an honest mistake. And then I will make sure to set up checklists to send to them and say, hey, don't forget about this. So when you own mutual funds, you're constantly receiving dividends. Even if those dividends are reinvested into your investments, you have to pay taxes on them as you go along. So dividends, interest, right? If you're an interest from your savings account, that is income. It's really important. Make a list. You should know what your income was, and the better your records are, the better you can then go ahead and start making a plan. Now, let's say, hey, you tell me, hey, Yehuda, I have a business. Okay, awesome. Let's see. Yes, yeah. For dividends, you'll get a 1099 DIV. And usually that's together with the consolidated 1099. So it comes all together with whatever brokerage account you have. Okay, so now you'll tell me, Yehuda, I have a business. What do I need to do for a business? So let me just break down the 4 categories or the 4 sections, and then some extra bonus stuff for a business. So when you own a business, and we're defining a business over here as a sole proprietorship. Now that doesn't matter if you have an LLC or not. If it's taxed as a sole proprietorship, then that goes to you. Remember, and I might have this written on a later slide, just because you have an LLC, that doesn't make any difference at all for taxes. An LLC is a matter of legal liability. It has nothing to do with taxes. There are more complex structures that can be related to taxes. So you might have heard of something called an S corporation, which is a very popular thing. Although less popular maybe than it should be, because people very often misuse it and don't stay in compliance, and sort of defeats the purpose. But for business income, there's 4 sections that you really need to be aware of. Your gross receipts. So that's everything you receive from everybody. Now, one thing to keep in mind, when you process income through a credit card processor, like let's say Square or Stripe or really any of these online processors, you have to remember that credit card companies take a fee. And the money you receive in your bank account, in your actual business bank account, and hopefully you have a business bank account. If you have a business, you need a separate bank account. We'll talk about that more another time maybe. But you need a separate bank account. So you receive that money. Really, you charged $100. You receive $98.50 or whatever it is, whatever the percentage that they take off is. You need to report that full amount. So gross receipts, full amount that you paid. Another reason for this is because you're going to get a 1099 that shows the full gross amount. And if your records don't match up with the 1099, eventually the IRS can come to you and say, hey, why doesn't this match? What you're supposed to do is report gross receipts, and then minus any returns. So there's a separate line for if you give a refund to a customer. Then there's cost of goods sold, which is if you sell products, that would be the cost of those products. So if I buy 1,000 chairs, as I sell those chairs, whatever the cost of those chairs were, I'm going to deduct that over time. That's a little more complicated when it comes to inventory. And then your operational expenses. That includes processing fees for credit cards. So it's really important to keep in mind all of those things. Now, I'm going to, if you want your accountant to love you, here's what you do. You send them all these things in separate sections. And then for your operational expenses, you break it up by category. It doesn't have to be perfect, but it has to make sense, and it has to actually be categorized. Don't just say, hey, I had $4,000 of business expenses. It doesn't work like that. Was 1,000, maybe 1,000 of it was for rent, and 1,500 of it was for office expenses, and 500 was for utilities. Whatever it is, just split it up by basic category. Your accountant will either give you a template. For my clients, I'll just take whatever you give me and then categorize it into the categories that are built into the Schedule C, which is the filing that you do for your business. But just basic categories. And if you're not sure, then just say what it was for and send that to your accountant to make that determination. We don't expect, I don't expect my clients to know tax law, but I do expect you to give me as many details as possible. It does not cost more money to send more words in an email. So send me everything you got. 2 categories that people sort of always mess up with is the home office deduction, and I'm going to touch on this real quick, and the car expenses deduction for when you have a business. Now, these are only for when you have a business. There's 2 methods for each of them. Either there's a standard amount that you could take for the home office, that's $5 per square foot of your home office. Now, you have to use that office or regularly and exclusively, and there's a lot of specific rules. Now, here's a great example of where tax planning actually comes in handy. If you call me on January 3rd and say, hey, I had a business this past year, and I said, okay, cool. Did you have a home office? And you told me, well, sometimes I sat at the dining room table, and sometimes I sat on the living room couch, and I had my laptop, and one time I even sat in the kitchen and met with a client. Well, I would say, well, that does not sound like a home office because you're not using it ordinarily and exclusively. But if you call me on January 1st and say, hey, I'm about to start a business, the advice that I'm going to give you is, okay, here's what you're going to do. In your living room, you're going to pick a corner. You're going to set up a little desk. That is going to be your home office. You're not going to use that corner of the living room for anything else. You're going to use it ordinarily and exclusively. And now you're going to be able to take a deduction for that home office. Now, similarly with car expenses, when you drive for business, and there are actually other categories as well that you can deduct miles, but you can, if you record those miles, you can go ahead and deduct them. But you need to actually record them ahead of time. You can't go after the fact and say, oh, I think I drove. I don't know how much, and I don't know where or when. You need to record these things ahead of time. So these are just things you should be aware of. And part of the reason they're a little more complex is because they're a mix of personal and business. We have to make sure we're not deducting anything that's personal on business, because not allowed. Business rules to remember, we touched on this before. LLC does not equal deduction. And here's another point. Just because I spent it from my business bank account does not make it a deduction either. If you spend personal money, which, by the way, like I'm going to repeat, like I said before, never commingle expenses. Never, especially if you have an LLC, especially because then you lose all legal protection, basically. Never spend personal expenses from your business account and vice versa. But just because you swipe your business credit card or your business debit card or use business cash does not make something inherently a business expense. A business expense needs to be ordinary and necessary. And like I mentioned before about the 1099s, you need to actually, your income needs to match up, should reconcile with the 1099s being reported. And if it's not, that means there's a problem. Okay, here we go. When do you need to talk to your accountant? Well, hopefully in any life event that you have. So that would be marriage, divorce, having children, some other type of family change. By the way, health insurance, believe it or not, is very related to taxes nowadays because of the premium tax credit. So if you have health insurance through the marketplace, excuse me, if you have health insurance through the marketplace, which a lot of people don't really know what that is, it got a little news coverage recently because this has been a big talk in Congress of whether or not to extend the extra COVID subsidies that people have been enjoying the past few years. But basically, there's a public option to receive health insurance through a state marketplace. Every state is different. So depending on what state you're in, you may be familiar with a different website. But regardless of what state you're in, if you do participate in health insurance from the marketplace and you get any sort of tax credit, or regardless of whether or not you get the credit, you're going to receive a form called 1095A. Now, this is not if you get health insurance through your employer. So the 1095A is for if you have a health insurance through the marketplace. Anyway, that form is really, really, really important, and you need to give that to your accountant. Now, I would almost say almost every form is important to give to your accountant, certainly. But this form, even more so, because if you don't have it and we file your return, it will automatically get rejected. The government knows that that form was filed. The states file that with the IRS, with the federal government. And then when we go to file your return, if you did not include that form, it will automatically get rejected. That's not the case if it's missing a W-2 or some other income document, but that is the case if you're missing your 1095A. So really, really, really important. Also, hey, if you're getting a new job, let your accountant know. Maybe that's a good time to sit down and do a tax strategy session, a planning session, update those tax estimates, update withholding. There is a 1095B, good point, and that's to report other types of health insurance. It's really only applicable for, like, the only time a 1095B or 1095C actually matter is if you, by mistake, have health insurance coverage through the marketplace and simultaneously have it through your employer. You cannot double dip, and you actually become ineligible I mean, the details are actually extremely complex, and it's certainly not simple. But you become ineligible for that tax credit if you had alternative health insurance through an employer. So those, regardless, you should always send those forms to your accountant, because you never know when a detail might actually be important and make a difference. Listen, security is really, really, really important, especially nowadays. I highly recommend everybody go and get an IRS IP pin, identity protection pin. It's not available until next year, and you need to get a new one every single year. But if you haven't yet set up an online account with irs.gov, highly recommend it. You can get a pin very easily once you're signed in. If you ever have trouble figuring out how to create an account, you can always give me a call, contact my office. We can help you out. But the IP pin basically means that you need to provide that pin with your tax return, so nobody else can fraudulently file a tax return with your information. It would get rejected without that IP pin. So I highly recommend it. The IRS is not going to ever text you. For sure not text you. They will send you letters. There are some circumstances where they might give you a phone call, but it would first come with, you would have a letter first. But the IRS is never going to email you. The IRS is never going to text you. And I'll say it like this: if you're ever not sure, just forward an email to me. Forward the email to me. Send me a screenshot of the text message. I will gladly help you out if I can help prevent one person from getting scammed. But the IRS will never, 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 never text you. So please don't click on any links that you get in a text message. If you get a phone call and they say, this is the IRS, you can probably hang up. And then you call me. Another thing is, don't email your tax documents. Email is not secure. Use a secure portal. All my clients know that I have a secure portal. It's an app on your phone. You need to log into it every single time. And that way it keeps your information safe, which is really important nowadays. Okay, here we go. The one big beautiful bill. So a little bit of background on what people are calling OB3. So there's actually a couple names for this. I think it's called like Public Law 190 something. That's like the official name, and then it was more colloquially known as the One Big Beautiful Bill Act. This was a big, what they call omnibus bill, where they stuffed a bunch of things in, and there was a lot of tax stuff and a lot of other stuff, but we're going to focus on the tax stuff. Now, you may see this referenced as the Working Families Tax Cut Act. That's like a thing that the IRS is saying here and there. It's like a little bit funny. I think there was a little bit of rebranding that was trying to go on, but the branding is not super consistent. Regardless, the OB3 I think is the easiest way to reference it. So this was the big bill. We touched on some of the subjects earlier. A large portion of this for taxes was extending the 2017 TCJA, the Tax Cuts and Jobs Act. So that was things like the larger standard deduction, getting rid of exemptions, although now there's a bunch of new things. There is a link here that you can go to and get a bunch of details on all the new things, but we're gonna discuss some of the things right now. So there's a new schedule. I'm actually gonna pull it up. It's really interesting to see, and I always feel like when you see the form, it's really helpful for really getting to understand IRS Form 1A. It's still in draft, which means it's not official. But here is the new beautiful Form 1A based on the One Big Beautiful Bill. And once you look at it, you can actually see a little bit better what is included for this tax year 2025. And it's really helpful because there are a lot of provisions that apply for 2025. Some start in 2026, some start in 2027. So looking at the actual form will help us get ready for tax season itself. So you can see, the first thing it figures out is MAGI, which it's called Modified Adjusted Gross Income. It's basically your adjusted gross income, which is basically your income minus plus a couple things, minus like certain foreign income exclusions, or excuse me, adding back those foreign income exclusions. But not super common. really only if you have foreign income. So section part 2 is no tax on tips. Now, again, like we discussed, it's not really no tax on tips. It is a tax deduction for tips you receive. Now, there's a bunch of rules. I read like dozens and dozens of pages of proposed regulations on this. There's a bunch of rules, but what's important to know is it's tips that you receive that I believe let's see, maybe it says it here. But it had to be in an occupation that customarily received tips before last year. So like back in 2024. So that does include wait staff, if you're a bartender, and a lot of other things, including also like beauticians and I believe even barbers, certain entertainers. It does include a lot, and mostly it's people who customarily receive tips. If you don't receive tips, then like don't expect to all of a sudden start getting tips and it making a difference. But we got the section on no tax on tips, no tax on overtime. So real quick though, the no tax on tips. So it's a $25,000 deduction. Now it's what they call below the line, which means it's after your adjusted gross income. Now, by the way, don't expect states to conform to this. Just because it's deductible, that deduction is only on the federal level. I know here in Maryland, Maryland is not conforming to this, which means there is no tax on tips deduction in Maryland on the state level, which means you're still going to be taxed on that. Now, hey, it's still a tax deduction, certainly helpful to those who need it. But yeah, so it's $25,000. Now, that could be up to 2 people, meaning it could be as much as, wait, was it? You know what? I'm going to have to double check on this. It could be, it's only up to $25,000, even if it's 2 people getting tips. But the threshold for it, for the income threshold doubles. So you'll see over here. So for no tax on tips, it's $150,000 for singles or $300,000 married filing jointly. Now, what's specific for this tax year that's not going to be the same as next year, and this applies to the no tax on overtime as well, is my brain's going a little faster than I can speak. Is that it's that the information that you need in order to claim these deductions won't be included on your W-2 or on your 1099. So that is going to cause a little bit of a funny issue. But hopefully most employers will give out separate statements separating and showing those qualified tips. Now, there is a spot on the W-2 that says tips, but that's not the same thing as qualified tips. I'm not going to get into too many of the details. Real quick, though, basically, if you go to a restaurant and they tell you that you need to give a tip. So, for example, like let's say over party of 5, that tip does not count as qualified, but it's only a tip that you give that's not mandatory. Now, no tax on overtime. So this one was a little tricky, and it took a while, even for us tax professionals, to really understand. The no tax on overtime is a deduction for the half of the time and a half for overtime. So usually when, according to FLSA, the Fair Labor Standards Act, if you work more than 40 hours in a week, you get overtime, which is 1.5 times your regular hourly pay. Now, what's interesting is not every state defines it like that. Not every state does overtime like that. Some states, it's like more than 8 hours in a day. Some states it's more than 80 hours in a 2-week period. So it's going to be a little tricky, and we still have a lot of answers a lot of questions that have not gotten answered. But simply speaking, it's a deduction for the half of the time and a half. So let's say you usually make $20 an hour. Time and a half would be $30 an hour. So that extra $10 an hour you're making during overtime, that would be eligible for deduction for up to $12,500. Or $25,000 if married filing jointly, if you both receive. And again, the income threshold limits are similar, $150 and $300. Now that brings us to the no tax on car loan interest. This is an interesting one because I'm really just not sure how many people this is going to apply to. You can deduct up to $10,000 of car loan interest if you purchase the car in 2025, and there is going to be a separate statement sent out. I don't think it's going to be sent out this year, but hopefully you'll get some sort of year-end statement that you'll be able to use in place. You're going to need the VIN number, so make sure to provide that to your accountant when you file. And there is an income threshold phase out of 100,000 or 200,000 married filing jointly. Now, here is the last one we'll talk about in this section: the enhanced deduction for seniors, or what they wanted to call no tax on Social Security. Basically, it's an extra $6,000 deduction for anyone above the age of 65. There are a little bit of details here and there. There's a phase out of $75,000 if you're single, or $150,000 if you're married and filing jointly. So you'll still be eligible for some, but you can see there's a little bit of complex math over here. It does phase out over time. So those are the provisions, I'll say, that are really specific for this tax year, which means filing starting in January. But wait, there's more. For this year, there's also two other things that's going to apply, that I know off the top of my head that's going to apply for this tax season. The SALT deduction increase. We spoke about this before. So let's give a quick recap on the difference between itemized deductions and standard deductions. Standard deduction is basically you make income, and the government says, and by the government, I mean Congress, our elected officials, made a bunch of laws over time. And Congress said you can either go ahead and take a set amount per person, which for this upcoming tax season for married filing joint couple is like $31,500, regardless of how much money you spend on things. Or you can use itemized deductions, which is a very specific list of things you spend money on. Now, that's, by the way, a great opportunity for tax planning, figuring out whether or not your itemized deductions make sense. So it used to be that state and local taxes, so real estate tax and income tax you pay to the state, possibly also sales tax, depending on your situation. It was capped at $10,000. And that actually messed up a lot of people in high tax states like California and Maryland, and basically any states that charge tax. Shout out to all those Florida and Texas people. Thanks for supporting the economy, and also good for you for not having to pay state taxes. But the fact that it got increased to $40,000 is really going to help make a lot more people eligible for filing itemized deductions, and it helping them a lot more. There's also these new Trump accounts for children. So if you had a child 2025 through 2028, you'll be eligible to elect to open up this new account called a Trump account. There's actually a new form called Form 4547. It just came out like literally the other day. Still in draft. I'll give you a little preview. It is a little bit on the nose, certainly. In case you didn't get the hidden message there, 4547, because Trump was the 45th and 47th president. So just in case the name did not infer it enough, now you know. But it basically pretty simple. It's going to include most information that you already have, and you already have on the tax return. Now, interestingly enough, this form can be filed regardless of the tax return. So if you have a kid in 2026, there's a new website called trumpaccounts.gov, which you can check out. They're going to be doing a full opening up more fully on December 17th. You can go to that website and sign up for updates to check that out. But basically, the point of this account is, well, for starters, there's going to be a $1,000 contribution to start these accounts, and it's going to be for the beneficiary of that child, which means, and people don't realize this, the power of compound interest. I feel like this is just too cool not to share. But let me show you an investment calculator. So this is an investment calculator. And if we put $1,000 over 65 years, right? Kids getting, and let's say 7% interest. That's not that much money. And we don't put any money at all other than that $1,000. I mean, that's $80,000. A lot of people don't retire with $80,000. A lot of people, now, let's say that does a lot better, like a more normal 11% average over time. I mean, you're talking about $800,000. Oh, let's say you add $5, or $10 to that a month. Well, now you have almost $2 million, and you only contributed very little. So my point is, this hopefully will get the conversation started for early investing. The best time to invest was yesterday. So yeah, there is thinking sometimes behind the tax form numbers. I think this is the only time. I think this is the first time ever that a tax form has ever had a number that meant something, which I personally thought was really funny. But regardless of that, so there's this new $1,000. Now you can contribute, use this form to elect to, or after July of next year, you're going to be able to elect to contribute more money into these accounts if you want, of your own money. It's and then also it has to get invested, and basically it grows for 18 years, and then there's like a bunch of rules about like what you can do with it. You can roll it into another. It's considered like a traditional IRA. Basically it's tax deferred, so any money that like dividends, like we discussed earlier, how dividends are taxable over time, so you can actually defer the taxes on those dividends, or the increase in value in whatever it is, or if things get sold inside that account. But so you can defer that income over time, and it's retirement income for that child. So, and there are also certain things it can be used for. Now, the hot off the press news is that if you've ever used a computer before, you may have seen the name Dell on that computer or on that monitor. Well, Michael Dell, famous for his Dell computers, just pledged to donate $6.25 billion to give a $250 contribution into Trump accounts for any children under the age of 10. So anybody that has any children under the age of 10 currently, hopefully those children will be getting that $250. I have not yet seen how exactly those kids are supposed to get that money. Maybe that's going to be on the website. Stay tuned for more details. But Trump accounts, it's a new interesting thing. I certainly think it's, a lot of people are saying like it's a bit extra, but hey, certainly I don't think a lot of people are going to be upset about the free money. You can't go wrong there. But regardless of it, I want you to take advantage for for your family, for your children. So now a little bit of stuff for next year. The charitable deductions for non-itemizers. This is a thing we saw a little bit back in 2020 and 2021, but starting in 2026, if you don't itemize, you can deduct $1,000 or $2,000 for married filing joint couple of charity. Now, this is a funny example where usually you see nonprofits going, get your year-end tax deduction in, which is usually true if you itemize your deductions. But if you don't, this is actually an example of a year, depending on how much charity you give, where it might be worthwhile to wait until January 1st, and you can actually deduct that next year. Now, also for next year, for itemizers, there's going to be a new 0.5% floor on charity deductions. So it used to be that you would just be able to deduct whatever you donate, and now it's going to be like, let's say you make $100,000, so you'd have to donate $500 before the charity starts counting towards your itemized deductions. So again, this is a great example of like landscape changing, like things are changing, and you really got to be in the know. I want to get to some questions. I know it's probably a little bit late, so certainly, if you have to hop off, I will not look down at you at all. But I want to get to a couple of these questions that people submitted beforehand. So there's a new tip credit for people in the beauty industry. I was looking at that a little bit. Basically, there was a certain tax credit for Social Security taxes on tips for food workers, and it got applied for people in the beauty industry as well. I have not seen much information on how that's affected, but people in the beauty industry are eligible for the deduction. So certainly be on the watch to see how that's going to go. Another question was about how to calculate estimated tax payments for the last quarter so you don't get hit with underpayment penalties. The calculation is a bit complex. I actually made a big spreadsheet that auto calculates most of this, so I can help people. Certainly if you're coming to me and we do a tax planning session, this would be something that's included. But basically, it's either depending on how much money you make, it's either 100% of last year's tax or 110%, and that is the safe harbor. So there's two methods when it comes to estimated taxes. There is let me just do this right here. So there's two methods Oh, okay. There's two methods for estimated taxes. Either you go ahead and you figure out estimates based on your actual income, which is a little more complicated, requires a lot more calculation, or you can do a safe harbor where basically you can use last year's numbers and either pay 100%, again, like I said, depending on how much money you make, either 100% or 110%, and split up into 4 payments throughout the year, the last one being due January 15th. So the best time to make those calculations is right after you file your tax return. Make those calculations, figure out what it is, and then make those payments. And then don't worry about paying estimated or don't worry about paying what's it called? Don't worry about paying interest and penalties because I don't want you doing that. Okay, someone said I got married this year. Well, first of all, congrats. That's so exciting. You should be blessed with a beautiful marriage. What is different about paying taxes? Well, a couple of things. First of all, now that you're married, you're going to be filing jointly or filing separately, depending on your situation. Most of the time, it makes sense to do filing jointly, and basically just helps consolidate your income together on one tax return. So it all goes together. Usually, things are better for married filing jointly. Happens to be there's so many different provisions and so many different laws. Sometimes that's not the case, but usually it is. So on a basic level, you're going to be filing taxes together. So make sure to get together with your spouse and find out what income they earn. Maybe they have investment accounts. Maybe they have other income that you didn't know about. So certainly find out. That's a great time to sit down. And by the way, let's see. By the way, this is a great thing to do for marriage in general. I would highly recommend sit down with somebody like me and let's talk about taxes. Let's talk about money, because certainly in marriage, money is a hot topic, and in life, money is a hot topic, and we can talk about taxes and get through a lot of relationship advice at the same time. Okay, Donnie, you asked, do I have to pay estimated taxes if I get a federal and state refund? So not usually. If you're getting a refund, that means you overpaid. If you know for sure you're getting a refund, then that's fine. If you got a refund last year, most of the time, depending on, there's a lot of details. It's a really complicated calculation, but depending on a lot of different things, you would not have to pay estimated taxes. But again, it's highly dependent on your situation. Now there was one more question. This was interesting. Someone said, I live in Michigan and work remotely for a company based in New York. Is there any way to escape New York taxes and pay Michigan taxes instead? This is a fantastic question. So I actually used to work for a company based in New York, and I was the finance manager. And what a lot of people don't realize is that New York is very, very interested in people's taxes. So they have very strict rules around who needs to pay New York taxes. And what a lot of New York employers, they take the lazy route, and instead of establishing a new tax account in another state like Michigan, they just go ahead and tax people in New York because it's easier for them. Now, for you, for most, I don't recall Michigan, but for most of the time, you would not pay double tax because usually you get either a tax credit or deduction in the state that you live in. But very often New York is higher taxes. So you really have to figure out what makes the most sense. The easiest thing would be to call up your employer and say, excuse me, I never stepped foot in New York. Please stop taxing me in New York. There's a whole list of very, very complicated, like nuanced little details about what creates an exception for New York. So something to keep in mind. But it is tricky, and certainly I feel bad for you if you have to also file extra tax returns just for the fun of it. Anyways, if you have any further questions, certainly you can put them in the chat here right now. But I'm so happy that you spent the time with me tonight to get ahead of ahead on your taxes, to hopefully take charge of your situation. I'm always open to questions. You can always reach out to me. My email is yehuda@y10tax.com, yehuda@y10tax.com. You can call the office, 410-962-7333 through 73333. It's 3 cubed. Also, if you're interested in sitting down with me for a pre-tax season strategy session, you can go to y10tax.com/strategy to learn more about how you could sit down with me, because I would love to take a look at your tax return and figure out how can we save you money now and plan ahead of time. I had a friend and his father used to say that it's never about lying. It's always about figuring out what will be the truth. And if you think about that, I think it's a great line, because tax planning is literally deciding what are we going to create in the future. Thank you so much for taking the time to be here. I really, really appreciate it. And it means a lot to me that I'm able to share this information with you. If you ever have any questions, please reach out. And I look forward to doing more sessions in the future, maybe on more specific subjects. Please, if you have any comments, questions, send me an email. If you have a specific topic you want to hear me talk about in the future, please reach out. Would love to connect further and do more of these sessions. So until next time, thank you so much and have a fantastic night.